Today's topic is related to tax treatment on government free money. Government free money need to be thoroughly free, and so we want to dive a little deeper to at least give you an idea whether that money you got from government, you need to report taxes or not. But really, overall, in general, folks, if you are just absolutely have no idea whether you should report the income or not, and you know you have professionals to ask that question, right? And you should not be assuming everything is not taxable because they gave it to me. And it is really not as simple as that. So you want to at least, if you don't want to listen to this webinar, and if you don't have time to understand debit credit, and you just want to get it done right, then you go to professional and to really treat your government free money properly. And when I talk about professionals, are professional people like Community CPA, right? People like us who knows what needs to be done. And so you come to us and we'll take care of you. All right, so let's begin. And I want to give you a quick summary of what we are talking about today in terms of whether they're taxable or not. If they're taxable, how are you doing it? If they're not taxable, how are you booking it? So those are really important information for everyone to know. And we have from the federal side, and the most famous five. That is what most of people are dealing with: stimulus money, Paycheck Protection Program (PPP), and economic injury disaster loan. That's EIDL loan and the EIDL advance, remember, and restaurant revitalization, and also employee retention credit, and the shuttered venue operator grant. Those are all billions that went out to individual taxpayers. So if you are here today, I know you got that. You got one of those, so you want to know what to do. All right. So generally speaking, when you receive a government grant, if it is a disaster-related relief, like qualified disaster, COVID-19 is a qualified disaster, and if it is qualified disaster, the federal government come out with welfare giving to general public and allow, this kind of money that you got, like our stimulus check in the very beginning, and Trump gave us two, and the Biden came on board, give another one. Remember, and also the unemployment benefit, remember in 2020, those are welfare-driven kind of grants. So those are, because it's all coming from pandemic, so they're qualified disaster. So the federal, state, and local government grants to individuals related to COVID-19 are tax-free. What does that mean? That means you're not going to get a 1099-G, and you're not going to get 1089 NEC, you're not going to get a 1089 miscellaneous to your name to say that, hey, pay taxes for it. Remember, you get that, right? You get 1089 NEC from your subcontractor work, so you need to report income and pay taxes. Of course, you can deduct your expenses. And if you got, payment, remember, we also have some sort of Medicaid kind of payment. If you take care of patients, you got a 1089 miscellaneous coming in for your work. So those are government payment as well, but they are taxable, right? But for this type of pandemic-related grants to individual is not taxable. So let's look at it in a little bit of detail. For year 2020, okay, for those folks who hasn't really filed 2020 tax return yet, Trump administration had sent 2 rounds of stimulus checks. Am I right? The first round was $1,200. If you're a couple, you got $2,400. And then the Congress approved further, one more round. That is the $600 per person one. So those two, you get them. You get them, and you actually report them on your tax on your 1040 2020. However, that you filling in that number on your 2020 tax return, it doesn't trigger you to pay taxes on it. What it does is to make sure that you actually got it. If you didn't have it, you don't put in the number, then your refund actually increased because if you qualify, they will give that to you. So it is yours, and it is yours forever. You don't need to pay taxes. Okay? Then for year 2021, the third economic impact payment amount came out. That's of $1,400 for the individual, then $2,800 for a couple, right? So you also, when that one came out, it has a lot to do with, it made it more clear about the Social Security EIDL and all of that. So for children, for each qualified child, and there is a $1,400 as well. So all of these is not income. They are government welfare giving to general public. So you actually will get it. If you didn't get it, you have on your tax return in 2021, there is, on the second page, there's a line called recovery rebate credit. If you don't put in a number in there, you're saying that you didn't get it. If you didn't get it, you will get it. The government will give you more refund to cover you for the $1,400 you missed. But if you got it, you need to fill it in so they don't give you again. Trust me, the system at the IRS is a lot better than what we think with all these billion people, and they're going to be confused. No, they actually know exactly who got it, who didn't. So even if you didn't fill up right, they correct you. So we had a couple of taxpayers come back for 2020 tax return because they told us they didn't get the stimulus check, but the IRS actually has a record that they got it. So a letter arrives, goes, no, you don't get this refund because you got it. So things like that, right? So this is stimulus check, and you will report it. You reported it only because if you report it, they know that you got it, so you don't get it again. But if you reported less or you reported a zero, they will give you that back. So it is a free money. You don't pay taxes even though you show it on the tax return, right? All right. Then let's talk about this FFCRA credit. This has twofold, and I'm going to talk about as employee, and I'm also going to talk about as employer, okay? This Family First Coronavirus Response Act and says that if you family members or you are sick with coronavirus, and remember you can get 2 weeks pay without any deduction, right? Your employer going to pay you just like normal, even though you are at home taking care of your little ones, right? So as an employee, you will have the taxable income in your W-2 as if you did not take the time off. You did. You went home, take care of your little ones, so you didn't work, but your paycheck goes the same. So your W-2 is going to have those income just as if you worked. So you pay taxes for that, okay? You pay normal. And that's where from the employee angle to look at that FFCRA credit, and it's no different from you worked. So you're going to be paying income tax, you're going to pay Social Security, Medicare, just as normal. It is taxable income to you, to employee. However, if you are the employer, okay, and the employee didn't work, but you paid for 2 weeks payment. So what the government allows you to do is to get that refunded back through your 941 filing. So what that says is, we give you that money back. You don't have any out. So that credit, it is going back to make up the payroll expenses that you spent. So let's say this person, you paid $2,000. So she didn't work, but you ran $2,000 paycheck just like normal. And now you're going to get that $2,000 from the government through FFCRA credit when you file your 941 return for your employer tax report. And you will get that $2,000 back. When you get it back, what you do is you will put it back into that payroll expense because you don't have that expense, right? So it will reduce your payroll expense. Now, let me just kind of take a little back on what I was just saying. So you receive that money from the government, and you take that money, instead of crediting to your income, you're crediting to the payroll expenses. So you're reversing payroll expense to recognize that you actually did not pay to that employee for the coronavirus related day off. Makes sense? So for employer, it reduces expense. On the other hand, when you reduce expense, what do you increase? You increase your taxable income, right? So we say that this is taxable. Does that make sense? Because it's taxable in the way that you increase the taxable income. So you pay more taxes. You got $2,000, but you reverse your $2,000 payroll expense, so your net profit is higher by $2,000. Got it? So it is a taxable income as it reduced your expenses. So that is our FFCRA credit. Now, let's go for PPP. Okay? PPP. You may got it once, you may got it twice. It's a big deal. And it's a big number on your financial. And just remember that when you just receive the PPP, and what you do is you actually book that as a loan, right? So you increase your bank, you increase your loan on your business, because that PPP is not forgiven yet. It is a loan, it is a liability. Then you use the PPP dollar, paid payroll, and paid other expenses, and you used it up. And in 2021, and you applied for PPP loan forgiveness, you got approved. Now what happens? And is PPP a taxable income or not? All right. So I want you to take a look at this next slide with me. All right. So on the PPP, and what the IRS already come up with 3 different instructions, not different instructions, 3 consecutive instructions to give understanding of how we should book PPP. So what I do here is, instead of giving you general, and I am going to split your PPP into, if you are partnership, what do you do with PPP? And if you are 1120S company, what do you do with PPP? And then if you are C Corp, what do you do with PPP? Because those are the main key differences between each entity that would really help you to figure out where you are, how you're going to book it. So let's look at this. PPP for partnership, okay? The PPP forgiveness amount, so say you got $20,000 PPP. We're going to keep on using the same number, so that will give you a good understanding. So say you have a business and made a $40,000 net profit. You have a partnership, made a $40,000 net profit, but you got $20,000 PPP forgiven in 2021. And that PPP amount you received, the $20,000, and it says that will not increase members' basis. Okay, I want to pause right here. I know when I talk like that, and a lot of you will be like, I don't know what you mean by that. Okay, just imagine, and when the basis is, you can imagine that the basis is almost like your worth of your partnership. So let's say you joined the partnership so long ago, you put in 10,000, and that is your base. That was your base because you put in 10,000. Later on, the company made money, made another 10,000, and you didn't take it out. Then your basis is 20,000. See, what the basis does for you is, when you, at one point of time, when you want to get away from the partnership, or maybe your business gets sold, the basis is almost like your stock base on the internet, where you paid money, then you trade the stock. When you got gain, it is the gain purchase. It is the selling price minus your purchase price, then you got the gain, right? So same thing in business. Whatever you had on your basis is tax-free. And if you have 20,000 basis and you sell your business for 20,000, what's your tax? 0. You didn't make any capital gain. You didn't make any money. Your basis equals to your selling price. But what if you sold for 40,000? Then your basis is 20, and you sold for 40, and 40 minus 20 equals to 20. So the other left over 20,000 would be your capital gain, would be your gain from selling business, right? So now base makes sense, right? Base is actually something anyone in business, if you go, well, I'm in business, but I don't know anything about bases. Well, I will say that you are really, really not watching what is important to you. Making money is important, but knowing what your business is worth is also important. If you are in your 20s, you don't care about your base because you're going to run your business for next 60 years, I understand you don't pay attention to, even though that's a bad idea. But not when you are in your 40s, 50s, and you have limited time to run your business and you don't care about your basis. No, you should care, right? So now let's look at a form. This is a partnership schedule M1. And if you tell me that, oh, I don't know what that is part of your form. If you go to 1065, there is a form called Schedule M1. So what I want to lead you to see is that right here, you see how the PPP was counted. That 60,000, remember our business as example, we say we made 40,000 profit and we had a $20,000 PPP forgiveness. So our total income, our total income is 40 plus 20 because we got 20,000 PPP forgiveness. So I report 60 right here. But you also see that there is a line called income recorded on the book this year, not included on Schedule K, line 1 through line 11, and they ask you to itemize. Right here, I itemized to PPP 20,000, forgive. So I ended up with income as 40,000. So that's my real income. I subtracted the PPP. So this is what your M1 will look like. Okay, now let me show you another form. This is you, okay? This is a partnership. So you, me, we are the partner. And I am 50%, you are 50%. So we made a $40,000 profit. Do you remember? So that 40,000 came in right here. Did you see? Don't look at that 25,000. That's our beginning balance. We're not talking about that. This 20,000 right here in the middle, that is the 40,000 because I'm 50% shareholder. I'm the 50% of partner, so I have 20,000. And then look at the PVP. I got 10, right? Because the 20,000 total forgive, so I take half, and then you take half, so I take 10. So my total income becomes 30, but I have change in liability because my PVP is forgiven. So my liability got reduced. Didn't I? Got reduced, right? It's forgiven, so I don't have that liability anymore. So I'll take into the deduction of that liability. So you see, minus 10. So I ended up with my basis. So that 10 is in on the top as income, and the 10,000 goes out as I reduce my liability. So for PPP, forgived amount, it is not your taxable income. That's number one. Number two, it does not increase your basis. So that's what we want to lead to. So let's look at this. This is your schedule. And this is the S corporate. Let me go back. I was supposed to go back here. This is the partnership M1, and we reported 60, but 20 of this is PPP. So our real taxable income is actually 40. And then on our capital account, it is in and out. So I go back to the conclusion I was making in here, saying that the PPP forgiveness amount will not increase member bases. The PPP loan forgive amount, PPP loan reduce the amount will offset each other. So basically, what is offsetting is the liability is offsetting what you got forgiven. So that's why there is no increase on member, right? So that is where I want to make sure we got conclusion for PPP on partnership. Number one, non-taxable. Number two, did not increase your basis. So now let's look at S corporation. So S corporation, same thing. We made $40,000 profit. We have 20,000 PPP forgiveness, and then out of the 20, and we are equal partners, and we are shareholders. So I have 50, you have 50. So look at this 1120S. So your net income is 60. See how you include the PPP into the total, but you make your adjustment already. See here? So you still, taxable income is 40, okay? Then your next one is, this is the shareholder base. So this is the similar to the capital account for the members, but this is for shareholder. But look at that. The shareholder, the tax-exempt interest and other income is 20,000, okay? And in this case, actually, I didn't really have a partner. I was doing it myself. So I have the whole 20,000 PPP coming in, increased my stock basis. Did you see that? So my stock basis was a 40,000 net income plus 20,000 PPP, and I have beginning balance of 30, so that's why I got total of 90. That increased my basis. So conclusion for S Corp is the PPP forgived amount. Number one, not taxable. Number two, increased shareholder base. Now, I want to show you one more thing under S Corp that you need to know, okay? And I know this is getting a little technical, but if you are the one doing your own tax return on Tax Act and the places like that, and then you will come across this as well. Before your PPP was forgiven, and your M2 should look like this. So this is my beginning balance. Remember, we made 40,000. And then on here is other addition. That's a 20,000. Okay. And then this 20,000 is just add up. So you have other addition of 20,000. But after you are forgiven, what you do is you are actually removing your 20,000, removing it. You see these two, this 20,000 under other adjusted accounts, OAA. We call that OAA account. You're reversing that OAA account to AAA account, which is accumulated adjustments account. You see how that becomes this way? You look at this basis is increased. So this is where just mechanically on your tax return, that's what you do with the forgived PPP amount. So this is before, this is after. Before you are forgiven, you stay this way. After you are forgiven, you're staying this way. If this is going to be a little bit foreign to you and you are not sure, take a picture, and when you do your tax return, you'll know exactly what I'm talking about. All right. Now, let's talk about C Corp. That's another one, very popular, right? Very normal. And we, among the small business community, and we have what? We have limited liability companies, partnership, and we have S Corp, C Corp. Those are most common, and the people would come to realize they need to treat PPP under this structure. So right here, the forgiveness of a PPP loan creates tax-exempt income. Tax-exempt income is just income that doesn't subject to income tax. Corporations can treat tax-exempt income resulting from the forgiveness of PPP as received or accrued. So what they're saying is, as a company, and you can treat the PPP amount, this loan, on your balance sheet, okay, on your balance sheet. So this is what M1 will be looking like. So again, $60,000 income, that includes the $20,000 from PPP forgive, right? And then you report $40,000 net profit. That is your taxable. That is your taxable income. And this M1 schedule is actually is matching your book to your taxes. So the number on your right-hand corner right here on this slide, that 40,000, that is being calculated for you to pay taxes. But the number on your left top right here, that 60,000, that is the number should be what your financial statement number is. So that is actually your book number. Then you reconcile for tax effect. Then you come up with 40, right? So let's see our next one. So this is the M2. Remember, we've been showing you M1, M2. So this is what the shareholder reserves, the shareholder owns retained earnings. So here, the 30,000 is from prior years. Then you have your 60, and then you have your 90. You see how that PPP forgiveness for that 20,000 is actually already in it. It didn't even come into play. It's just part of the basis, the part of reserve for the shareholder. Now, we kind of run through a train ride for PPP, right? So PPP is related to your structure. And when you treat PPP, you are treating it under your special structure. Whether you are a partnership or S Corp or C Corp, you can't just, pretend it didn't happen, because you need to identify that on your tax return, okay? It is a tax-exempt income, but it doesn't mean it should be a ghost income, doesn't show on your tax return. Just like recovery rebate we're getting individually, you're getting that money and it shows on your tax return. Doesn't mean you need to pay taxes, but it still needs to be announced on the return so the government knows that you have that properly reported. So now let's look at, so we talked about PPP. And I want to mention to you that what we talked about PPP, that is also the similar treatment for RRF. Maybe a little more complicated, but RRF, it is going through the same, you have to apply, you have to use it and, calculate it under different structure. Depends on what kind of tax structure you have. All right, so now let's look at EIDL loan. EIDL loan is a loan. It is not a tax-free grant. So when you get EIDL loan, maybe you got a $2 million, maybe you got 200,000, whatever number you got, that's not your income, period. It stays on your balance sheet. It is your liability. However, the reason we listed here, because we're talking about government-free money, we listed here because there was something called advance, right? EIDL advance, remember? That $10,000, $1,000 per employee up to $10,000. People got that. So what is that? Is that taxable? And so the Congress is the one and provided through CARES Act and made this low interest EIDL loan. And while people are applying for EIDL loan, at that time, the SBA give out what they called loan advance. So it is emergency advance program, give EIDL loan applicants, if you apply for the loan, and that $10,000, it is a grant. If it is grant, and it is based on the disaster COVID-19, therefore is tax-free. The supplemental targeted advance provided a supplemental payment of $5,000. That is also grants. So the grants are qualified for disaster grants, so therefore they're tax-free. What does that do if it is tax-free? Tax-free means you don't need to pay taxes on it. So you received it, you will add into your total income, then you run it off as a tax-free grant. Remember, we demonstrate that to you on the M1 schedule, right? So you want to recognize what you got it, but you want to exclude that from your tax calculation. This is where, if you never do taxes professionally or never paid money to have the third party doing it for you, trust me, 2020, 2021 are the years worth of having professionals and the tax preparer to do that for you, because you need to treat those money correctly. You cannot be treating them as grandma's mason jar and it just kind of forgot about it. It is tax-free, so why am I even bother? No, you need to identify that on your return. You need to treat it so it won't calculate taxes on you. All right? So that is the EIDL loan and the grant, disaster grants, tax-free, so no taxes. Restaurant Revitalization Fund, RRF. RRF are not taxable income for federal purposes. And the reason we put federal purposes because it's very complex. And I want to mention to you that including PPP and every federal grant, the state has its own ways to treat it. Some states will follow federal guidelines. If you don't charge taxes, we don't charge taxes. So you can roll over whatever the treatment federal has to the state. But I'll tell you, Utah is not like that. California is not like that. And not all the same, even in Minnesota and Iowa. So you want to know what the state treatment is. So we actually have this portion. We plan to take this portion out of today's talk and put that into Tuesday. For 30 minutes, I will cover the state side of difference. But right now, for federal purposes, and you don't pay taxes for RRF fund. This fund has a special way of spending, right? You, of course, spend on the operating side of the restaurant operation, but the spending was told has to be for from the March 11, 2020, all the way to March 11, 2023, remember? So not every restaurant will be able to spend all of it in 1 year. So you need to file annual report for 2021 December. I hope you already did that. Then you're going to file another one on December of 2022. If you're still not finishing spending it, you will file your final one on March 11 of 2023. By March 11 of 2023, you should be done with IRS money. So now, you've got the money in one chunk. You got $1 million in one chunk, and you are going to spend them in 3 different times, 2021, 2022, and the first 3 months of 2023. And in that case, you need to recognize your expenses accordingly, right? So you want to move your money to your gross income. You will say you spent $350,000 in 2021. Then you will recognize total income $350,000 as an income, and then you will run that off as a tax-exempt offset. So that $350,000 is gone. But you spent the $350,000. They are listed on your income statement, broken into different categories: securities, cost of goods sold, and rent. All of that is going in there. But it is the expenses is allowed to stay there to offset the income you got from the restaurant operation. Your RRF fund do not take that away from you. Your RRF fund shows up on M1, and you will recognize that's a total for the book, but your taxable income is the total minus your RRF amount for that year. And for that year, I mean all the expenses you spent for that year of the RF funds, because you're spending it, right? You're using it to support your operation. So whatever you spend in 2021, that amount will increase your income and it will decrease your income, and your expenses will go in as normal. All right? So don't forget about the annual reporting requirement, and you need to match your annual reporting requirement to your income tax. So really, and if this is not a year you're looking for professionals to get your taxes done, you know, which year gonna be the year? I mean, this is the year. You cannot do one thing with SBA, do a different thing with IRS. They're all federal government folks. And, you know, with technology, the government information sharing is so million times better. And you can, you know, in our profession, we feel it. We knew. It used to take 3 years for the government to match to something. Now it takes 3 months because their system is connected with each other. We can even see more and more connection between the state and the federal. And when you get audited by the federal government, and don't you know that you will get audited immediately by the state? How did that work? Because the system connected. They will tell, the federal government would tell the state that I audit these people and they owe like $3 million taxes, so they have a lot of tax you need to pay to you, and assess them. So the state comes too. All right. So the states are treating RF differently. This is where I want you to know. California tax on RF fund. If you don't know, I just gave you an example. So, but you can deduct all of your expenses, but they do make you to put that RF as an income. They don't let you run it off as a tax-exempt income. They want you to put the $350,000 on the income. Sure, you can deduct all your expenses. So basically, it's taxable. Basically, your RF fund will pay taxes in California. You see how that is different from the state to state? And Utah is the same. So you want to look into your state to understand how they want you to treat RF funds. All right, so accounting for IRF. You book the total of IRF funds as advance payment. This is just my sidekick. I don't know. I don't have a good word for it. I just want to tell you that, you know, you got $1 million, ladies, but don't put that on your income as $1 million because you didn't spend it all, right? You only spend 1/3 of it, so you need to put your millions on the balance sheet and then move that 1/3 over to income statement. Am I making sense, or I'm making no sense? But I bet you if you are accountant or semi-accountant or bean counters, you probably do know what I'm talking about. And each year, on December 2021, December 2022, and March 2023, and move the advance payment to income and offset tax-exempt income. That's literally what I'm saying. That's literally what you should do. So now I give you a very quick summary based on RRF related to the PPP. Do you remember we talked about how the PPP related to the base? And do you remember how I was talking about base? And I mean, I'm really talking about base, like in the football. I mean, the base you have, and you just don't really want to let go of that. That base increase from the federal grant existed in S corporation world, existed in the C corporation world, but it does not exist for PPP on the partnership level. But this RF grant and its increase, it's actually increase and decrease partnership basis at the same time. And the S corporation is increased S corp and increased C corp shareholder reserve. So these are RF fund treatment that you have on the shareholder basics and shareholders base. And that's what we are talking about. All right, let's look at employee retention credit. So a lot of people, a lot of employers are still working on employee retention credit. And employee retention credit is a broad-based refundable tax credit that's designed to encourage the employer to keep employee on payroll, okay? So for employees, let's talk about what employees' impact is. So there is no difference because employees get paid, and whether it is ERC money pays them, or PPP money pays them, or the employer's sales pays them, makes no difference. It's taxable for employees. So employees don't really need to identify where the funding sources is for their payroll. So they get K-1, they report taxes, right? But for employer, while the amount of ERC received is not includable in the gross income, the expenses giving rise to ERC are not deductible for tax purposes. And it's real Chinglish, right? I didn't make that up. I promise you I got that from the IRS website. So it's not Chinglish, it's a real English. And what that means is the ERC, that money you got, and you need to use that money to reduce your payroll expenses. You know how in business you have sales, then you reduce your payroll, you reduce your cost of goods sold, and you come up to the net profit. If you have a net profit, you pay taxes, otherwise you don't pay, right? So the payroll expenses is expense that reduces your taxable income. But what this ERC is that the ERC only offset your payroll expense. Let's say if my payroll expense is $1 million, I made a $3 million sales, my payroll expenses is $1 million, so I pay, let's say I don't have any other expenses, so I would pay taxes on the $2 million, right? Right? So, and if I don't have my $2 million, if I don't have my $1 million payroll expense, say I got an ERC for it. So ERC came in, reverse my $1 million to zero. Then how much do I pay? How much is my taxable income? Wouldn't that be $3 million, right? So in the way, wouldn't that say, to make it really simple, wouldn't you say that ERC is taxable? Yes, it is taxable because it is used to reduce your payroll expense. And if I make your payroll expense less, you're going to pay more income. So it's taxable. All right. So now let's look at this. If a taxpayer receives a $1 million ERC, then it must reduce its deductible expenses salary by $1 million. Now, if you receive your ERC credit now for 2020, you already finished your 2020 tax return. So what happens? Your payroll expense did not get reflected properly because you got a credit. You got ERC refund. That's supposed to reduce your payroll. You're supposed to pay more taxes. And so that involves the amendment, right? You would amend your taxes to reflect that ERC money you got. The state treatment of federal taxes, some states allow taxpayers to deduct eligible expenses in full. Others follow federal tax treatment and disallow expenses up to the amount of ERC received. So this is, again, just reminding you that the state treatment for that is not the same as what the federal treatment. You know, it is really kind of a interesting concept for me. You know, I never really come to realize how much democracies in our system there is, because every state of our country, they can actually change things, do different tax laws. So you have some states without income tax, some states with income tax. So every state is exercising their muscle and based on their economic condition to decide how to raise funds for the state to make the state better. So, I mean, the state without income tax obviously attracts seniors to go to just because they don't want to pay taxes on their, retirement earnings, so they go to those states. So, the state uses a lot of power to manipulate their income inside of state. That's democracy, because our federal government don't really have that much of an influence to the state when it comes to dollars. Okay, so with that, I would just remind you again, whatever federal government grants you got, and whether the state is treating it the same or not is completely up to the state. So you don't assume what federal government does is what the state government do, because they don't. They are different. And in fact, Iowa is one of those states are very, very willing to go with what federal government is doing. So our tax side of complications is a lot less than some of the states who are a little bit arrogant, I think, in terms of personality, state personality. And Iowa, in the way, I felt like it's very down to earth. It's kind of trying to make it simple. So a lot of things you can see, they're just following what federal government is doing. All right, so this one is a shattered venue operator grant, which is our last one. This one is actually for those entertainment theaters and the people in that business. They also got funds, but they don't call them RRF for the restaurant. They are calling them SVOG. So that is a fund they're getting. Again, this is the same. It's a disastrous government grant, so it's tax exempted. So they don't pay income tax for that. But when you are one and filing expropriation return, and remember your M1 schedule is supposed to include all of the income and also what you got from the government, then you also reverse that out as a tax exempt income, and you don't calculate tax on it, but you recognize the receive of the amount. So same thing, and whatever you spend, and you can still deduct it on the income statement. It doesn't stop you from deducting it out of your actual operating income. So you might end up to be a loss because your governmental grant, it is in and out, so it didn't impact you, it's not taxable, but your real income may be very little, but you have a whole bunch of expenses you can deduct, so you have a loss. And if you do, and you have a loss, but you have this money in the back end to help you to still maintain your business. So that is the whole purpose of these kind of governmental disasters relief funds, right? All right, so we are down to, actually, the rest of it is related to the state, but I am concluding today because we're already up at the hour. And so know that all of our webinars are coming into here at the end of the day, and you can always check what we were talking about. I can't believe I was wearing the same sweater last time when I was doing this W4, but anyway, and you're not here to see what I put on, but you are coming here to see what content and I'm giving you and our firm is giving you. I hope you thoroughly enjoyed the learning from us, and make sure you subscribe to our channel so you always know when we come online to talk about certain things. And as a community CPA, just like the name suggests, we really want our community to be knowledgeable. Knowledge is power. The more you know, and the more you know how to ask questions. The more questions you ask to your tax preparers, the better chance your tax return is being filed correctly. So we hope to hear from you, and if you have questions to ask, and I do answer those questions on YouTube, just so you know. And I'll talk to you again. Have a great weekend.